You have probably seen the recent headlines. China owns over $1 trillion of United States national debt. It is often framed as a hostile action, a national security threat, or a predatory payday loan that gives a rival nation dangerous leverage over the American economy. To understand what is happening between these two economies, we can look at a much smaller scale. Imagine you run a highly successful local bakery. Business is booming, you are selling thousands of cakes every week, and at the end of the day, your physical cash register is completely overflowing with dollar bills. This diagram shows what happens to physical cash over time. If you leave all that excess money sitting in the register or stuffed under a mattress, you face two very practical risks. First, it is entirely vulnerable to theft. Second, thanks to inflation, that static pile of cash actually loses purchasing power with every passing year. So, as a logical business owner, you do the obvious thing. You take the excess money out of the vulnerable register and deposit it into a secure, interest-bearing bank account for safekeeping. On a macroeconomic scale, China operates a lot like the world's biggest bakery. They manufacture and export a staggering amount of goods across the globe, and because of how much they sell to America, their national register is overflowing with one specific currency, US dollars. When China buys US debt, they are simply a successful business looking for the safest bank account to park their massive pile of excess cash. To understand exactly how China gets all those dollars, we have to look at the sheer volume of trade. Every single day, American consumers and businesses buy billions of dollars worth of manufactured goods, from computers and smartphones to machinery, directly from Chinese factories. Trade does flow in the other direction, too. The United States sells plenty of valuable products back to China, particularly large commercial aircraft, heavy machinery, and specialized industrial equipment. America also exports millions of tons of agricultural products across the Pacific, with crops like soybeans making up a massive portion of those sales. But even with all of those airplanes and soybeans heading east, the scales are completely tipped. This bar chart calculates the actual difference between what the U.S. buys and what it sells. That gap is called a trade surplus. A trade surplus occurs when a country exports more goods to its trading partners than it imports from them. Because American consumers buy vastly more goods from China than Chinese consumers buy from America, the mathematical result is inevitable. Hundreds of millions of US dollars transfer into Chinese corporate accounts every single day. With billions of US dollars piling up, the Chinese government faces a choice of where to spend it. They could theoretically use that cash to build domestic infrastructure, hospitals, and high-speed rail. However, they encounter a currency mismatch. Chinese construction workers, material suppliers, and domestic businesses cannot pay for their daily expenses with US dollars. They require local currency. Specifically, they need the RMB. The RMB, or renminbi, is the official currency of the People's Republic of China. To solve this, Chinese exporting companies take their earned US dollars to their government. The government takes the American cash and hands the exporting companies the equivalent amount of local RMB, allowing those businesses to pay their workers and keep operating. Ultimately, all of that foreign American cash ends up sitting in one centralized place. It goes straight to the PBOC. The PBOC is the People's Bank of China, the central bank responsible for carrying out monetary policy and managing the nation's financial reserves. By dominating global trade, the Chinese central bank has accumulated trillions of US dollars. But because those dollars are legally and practically useless for buying goods and services inside their own borders, they are stuck holding a mountain of foreign cash. The central bank now faces the exact same dilemma as our local bakery owner. Sitting on trillions of physical and digital US dollars guarantees they will lose billions to the invisible tax of inflation every single year. They have to invest it. This matrix shows why typical investments don't work. They could buy gold, but storing heavy metal is impractical, and prices are volatile. They could buy global stocks, but the market is too risky for sovereign reserves. Investing trillions on behalf of a nation requires two non-negotiable criteria. You need stability, guaranteeing the asset never loses its initial value, and you need liquidity, meaning it can be sold instantly for usable cash if an emergency strikes. There is only one asset on the planet large enough, safe enough, and liquid enough to meet those exact criteria: United States Treasury bonds. A Treasury bond is essentially a highly secure loan you make to the US government, which agrees to pay you back your original money plus a fixed rate of interest over a set period of time. When China buys these bonds, they are trading their idle cash for a guaranteed interest-paying IOU. And that IOU is backed by the full faith and credit of the United States government, an institution that has never defaulted in the history of the country. US Treasury bonds provide the safety and liquidity required for a nation's life savings, making them the logical parking spot for China's massive trade surplus. China's strategy of holding US debt functions as a practical, defensive financial mechanism to protect their wealth from inflation. This necessity creates a continuous macroeconomic loop between the two nations. This map traces the complete cycle. It starts right at home. Everyday Americans send their dollars across the ocean to China in exchange for affordable electronics, clothing, and manufactured goods. China collects those dollars, but because they can't spend them domestically, they take those exact same dollars and send them right back across the ocean to the US government in exchange for safe, interest-bearing treasury bonds. Finally, the United States government takes those return dollars and spends them right back into the American economy. They use that borrowed money to fund domestic infrastructure, pay government salaries, and maintain public services. It is an incredibly interconnected relationship. American consumers get the affordable goods they demand. China gets a perfectly safe vault to store its profits, and the US government gets a steady stream of cash to fund its operations. Both economies currently rely on this continuous cycle to function smoothly. The global economy functions as a complex, logical web designed to keep capital moving safely around the world.